coming in from HDFC Bank. We're seeing rise in the gross NPAs to the extent of 13% during the quarter. We're also seeing the net interest income is slightly below estimates, as well as this little bit, the profit also rather has been slightly below expectations. In fact, the profit stand at 7,730 crore, which is lower than 18-hour poll expectation of 7,900 crore. The net interest income stands at 17,000 crore, growth of just around 8.6%. It's lower than expectations. However, we are seeing that the fees and income has grown at 74% YOY. Miscellaneous income, including recoveries, stands at 600 odd crores. But management does state that COVID second wave has disrupted business activity for 2/3 of the quarter. Lower business volumes coupled with higher slippages led to lower revenues as well as higher provisions. Q1 saw a decline in collection efficiency and higher provisions, and Q1 credit cost in fact has risen to 1.67% versus a 1.64% in the previous quarter. Do note that the credit cost stood at 1.54% in the same quarter last year. In fact, the management does state that the total provisions, which includes all specific, floating and contingent provisions, stands at 146% of the total gross NPAs. So yes, they are adequately covered, but clearly Q1 is showing signs of the COVID impact, and we will have to watch out for management commentary that is the worst over on account of the COVID second wave, or will we see spillovers on the asset quality front even in the next quarter. In fact, let's look at the subsidiary performance. HDB Financial, which is an NBFC of HDFC Bank, its subsidiary, for them the gross NPAs have risen sharply to 7.75%. I repeat, the gross NPA stands at 7.75% versus a 3.89% in the previous quarter. So yes, that's a sharp rise in HDB Financial's gross NPAs as well. The profit for HDB Financial has been flat, but HDFC Securities, it's another subsidiary, the profits has grown handsomely at 95% at 260 crore. Speaking about HDFC Bank, well, they had already shared the Q1 update that the loan book has grown at nearly around 14%, led by growth in the commercial and rural banking as well as wholesale banking. So the wholesale banking book has grown 10%, commercial and rural banking has grown 25%. And while the retail loans are up 9%, management in the Q1 had already, in the Q1 update, had already shared that the retail disbursements were going slow, and hence the management commentary in terms of the outlook on the loan growth would be fairly important. On the deposit book front, it's a growth of 13%, led by CASA growth of 28%. CASA ratio now stands at 45.5%. and the margins are largely stable at 4.1% versus the 4.2% in the previous quarter. So yes, watch out for the management commentary on the asset quality impact, on the further update in terms of how the credit card business is shaping up, and are we seeing another nod or another feedback coming in from the Reserve Bank of India, and how the fee generation shapes up. If you look at the stock, well, the stock has been trading at close to around 3.1x FY23 price to book, and going into trade it was up nearly around 2% in the month of July. It's definitely underperformed so far the Bank Nifty, but yes, we'll have to see how the stock reacts on these numbers.